And so we believe very, very firmly that anyone can be an entrepreneur.
If you just bought and held the top 10 stocks from today and you held them for 10 years, I guarantee you'd more than double your money in the 10 years.
Wow.
Hello, everyone. Welcome to another Wealth Within update. I am Jim Beach of School for Startups Radio, joined as always by Janine Cox of Wealth Within. She is their senior wealth analyst. Janine, good to see you again. I like it when Dale is on vacation. How are you today?
Fantastic, thank you. A lot better than you, given that you've been through all these storms lately.
We've had quite a few storms and riots and all of the fun things here in Atlanta. So we're excited to get back to the hot, steamy summer.
I'm sure you are. And look, Dale will be glad that you haven't forgotten about him altogether.
How could we forget Dale, our sponsor and boss? So
that's right.
Let's get down to it. What did you see in the market last week?
Yeah, very interesting, isn't it? The market initially dropped, so it actually fell quite strongly first on Monday, about 3% down, but it actually ended up 1% for the week, which is interesting. So a bit of resilience coming back in to the Dow there, and the S&P 500 was much the same. It ended up about 1.86%. So I think this is all about indecision at the moment.
So what does that resilience versus indecision mean?
Well, it's about firstly the experience closed the market. Generally, they say so. At the end of the week, if the market's down, then you'd expect that those in the know are foreseeing further potential falls. If the market pushes back up towards the end of the week, then there's a potential for a short-term rise. But it wasn't strong, so I think that what we're looking at here is I think the market's had its run, and so now there are a lot of people factoring in, well, is it going to fall? People are questioning, is this a bubble? There's a whole lot of talk, and that's what we're coming up to further discussion about.
Well, Dale and I, and to some extent you and I, have been talking about this for, 2 or 3 months now, that the market does not seem to relate to the life that I am living. That me and so many other Americans are just scared to death because of the pandemic, the riots, the ending of police, all of these things. And at the same time, we see the market go up 900 points that day. And we're looking for a bomb shelter to go live in. And we look at the market and go, what? I've had this sense for just a long time that this rally has been based on the idea that the COVID is gone. And every indication is that there is the first wave still going on, not a second wave. The first wave is still going on. So I don't see the market related to my normal existence, what I see on the TV at all.
Yeah, and look, you're right. I mean, if you look back historically, you would be thinking, well, okay, this doesn't make sense. There's a lot of debate about whether or not that we're seeing a stock market bubble at the moment, and companies are trading well beyond the usual earnings equations, and there are stretched valuations at the moment. People are hanging on the edge of their seat waiting for the news in reporting season, hoping it's not going to be as bad, but there are people out there that want to be vindicated, of course, to be right about the market being a bubble, and we don't really care whether it is a bubble or not. We're hoping that the market will settle down to some sort of normal. If we were right and it turns out that the market gets sold off, then you just prepare your strategy to suit that. But I think there's a lot of people calling it at the moment, and the problem is that historically this is different, because when you have a market bubble, typically what happens is we were talking about that irrational exuberance which we saw, but typically you see that across the board. Now, we're seeing a massive amount of people who have been entering the market. Some brokers are saying that their new accounts are up 500% in the last few months of, I think it was March, April and into May. So when you've got that happening, it's a different end of the market that's moving in. That typically happens towards market peaks. However, those people who have been bullish about the market for some time are a bit more conservative and stayed, including us, and so therefore you don't have that broad picture of the whole market being bullish, which is typically what happens towards the peak. Now, historically, the new people that enter the market do so 12 to 18 months before a top, which is always interesting. So this is what puts a question in my mind. Everybody in the main is thinking doom and gloom. The new entrants to the market are pushing it higher. The savvy and the big institutions are taking advantage of the downside and the upside, short-term opportunities. So, it's not clear at this point where things are going to end up. So I think what people have to do is be conservative about their investments in the market, but be willing to exit if it does go down strongly over the coming months.
I think there was an article in Morningstar about all of the new millennials investing, and I think there was also an interesting Warren Buffett quote this week.
Yeah, look, the thing that Warren Buffett's always got something interesting to say, but I guess firstly, before that, the people who are more conservative and sitting on the sidelines, there's so much cash. I don't know about in America exactly what the dollar figures are that's sitting in cash at the moment, but in Australia there's a lot of money sitting in cash, especially superannuation and people's savings and investments, and people have been parking more money over recent months. We talked about recently people are saving more, so that money's sitting there and people are wanting to do something. And so I think that there's still a potential for the market to go higher if we ride out this period and if the pandemic doesn't escalate further. But you were talking about Warren Buffett, and I was reading an article by Morningstar, and this led into a quote that came out from Warren Buffett some time ago, and he wrote a letter to Berkshire Hathaway shareholders back in 2000, and this is describing the way that bubbles unfold and what typically happens. He said, "But a pin lies in wait for every bubble, and when the two eventually meet, a new wave of investors learns some very old lessons. First, many in Wall Street, a community in which quality control is not prized, will sell investors anything they will buy." Interesting statement, and we saw that during the GFC, but is this period the same? Well, that's what we're all questioning. And second, speculation is most dangerous when it looks easiest. And this is what we're seeing from these new entrants who are flocking to the market, bragging about the tens of thousands, in some cases, a lot of money that these people have never traded the market before and making at this point. And look, I wish them well. I'm not being critical of them. I'm thinking, okay, great, you've seen an opportunity and you've got into the market, but from this point, don't let your ego get the better of you, because the market always teaches people a lesson.
Yes, it does. And you need to have ridden through several cycles to learn. So, as always, the sage of Omaha is right. Good old Warren Buffett. Though he has missed a lot of stocks. It's interesting. He's done so successful, but he's missed whole industries. We'll talk about that another day. We need to move on to two things in particular. First, let's talk about Spotify and some of the things happening in that industry that, again, maybe here's an example of irrational exuberance, again, in one particular industry.
Yeah, it's just gone off the chart, Spotify, at the moment. What's really interesting about stocks, it hasn't been on the market all that long. What's interesting about the ones that have only been around for a year or so is that they often stocks, around 50% of stocks that launch onto the market, within the first 12 months, they're trading much less than the price that they were issued at. And this is the case with Spotify, but more recently it's actually broken well above that. And the news is about the Kardashians. Whenever the Kardashians come into the media, there's always some attention given to it. Kim Kardashian West, that she's made a deal with Spotify. This is all about the podcasts that they're streaming. So for those who are not familiar with Spotify, and I'd say that there would probably be few people out there who haven't heard of it, but it's a digital music streaming service. So Kim Kardashian is obviously signed a big deal there, but there's also a global licensing agreement that recently Spotify has signed up with Warner Music Group. So that's another big thing. And the brokers at the moment are putting big targets on Spotify. I saw $275 was the highest one there. Now the stock closed at $231.29 last week, up from $178 23. Interestingly, it did get to a high of 242. Now, my analysis showed that it had the potential to go to around 240, and I think this is where it could sit for a while. But in this market, with people betting big and almost gambling on even the airlines we saw last week, anything could happen. And there is a potential for $280 around what this broker had said, just looking at my charts. But this is an example of speculators jumping in when those in the know are banking on greed, because the stock had already been rising for a few months before this information came out. So it's about greed and FOMO, a fear of missing out, I think.
I think it's also one of the signs of the end of times in Revelation in the Bible. When the Kardashians become the pinnacle of society, you're pretty much doomed, I think. So, this is anytime we see Kardashian news, I just roll
Cringe.
my eye. I do. I cringe.
But you're all about marketing as well and business. So,
that's true.
From a business empire and marketing point of view, what are your thoughts on that with the Kardashians?
Janine, you called me out. You are right. I am. Let me say this. No one has ever done more with less than the Kardashians, so absolutely no skill except marketing themselves, and they're marketing nothing. So you have to give them respect for that. Turning themselves into billionaires on their skill set is again the end of times. We've hit the end of times. All right, let's talk about another sign of the end of times. Sneakers at $5,000 a pair. Talk to me about Nike.
Nike, yeah, fantastic brand, isn't it? I mean, that's the big thing with retail spending. People buy on emotion, and we've seen lots of articles about what's going to happen. We talked a bit last week about what will happen with retail spending, whether consumers have changed their habits given what's happened with COVID and people are not venturing out as much to the mall. So therefore, has this changed people's way of spending, and how much of an impact is that likely to have on Nike? Well, the shares closed low last week, which is interesting. I mean, when I think of Nike, I think of basketball. What do you think about?
Yeah, track and field sports, of course, yes. Basketball players. Mm-hmm. Yes.
Okay, so look, so the stores have been closed, and are people buying online? We've talked about that. We won't really know, but analysts are expecting a 25% drop in revenue. However, EPS is expected to be neutral, so they'd be doing well if they're able to maintain that. All-time high, 105.62 in January. The recent rebound saw it come close to this level, but then the stock price has come off the boil. Now, I think that having a big brand like that in a market rebound, it's going to attract a lot of attention from if the newbies and the entrants coming into the market are the millennials, a lot of millennials and a lot of younger people or people who are cashed up who don't know much about the market, they're going to go for products or brands that they recognise as, like I've got shares in Nike, it's one of those things, isn't it?
Makes sense.
But the price closed down at 95.78 on Friday, so it's a bit softer. And I think that if Nike disappoints the market this week, which it may do, it could be heading for $90 and may even settle lower prior to the announcement. So people who have bought in thinking this is going to be a big thing, they might get a bit of a shock if it goes the other way strongly, which in this market anything could happen. It could do that. So the real risk there for Nike is if it does trade to this level, there is a potential for that, for a fall even to between $74 and $80.
Which I would have to think at that point would be a buy. I would buy it at that low. That's a great price for a great brand, as we said. And I always think of Nike almost like Porsche. It's a luxury item. You don't buy a $5,000 pair of shoes as a necessity item. And when times are tough, the first thing we're going to cut back on is luxury shoes, I think, and Porsches. So,
and you don't want diamonds on your Nikes?
Excuse me?
You don't want diamonds on your Nikes? That's not the big ticket item for you.
I am a Costco shopper. I buy all of my clothes at the Costco, Price Warehouse. So my last pair of shoes was $11.
Wow.
So,
okay.
And I felt like I overpaid.
I think you should just spoil yourself and go a bit beyond it. Maybe a pair of Nikes is a good idea.
I'd rather spoil myself with a new computer or something like that. So,
Okay.
and I bought a new iPad Pro this week. Finally,
Oh, fantastic.
Dale and I have been talking about it for weeks, months actually. I finally broke down and spent the $2,000. And don't tell my wife, but I also bought the laptop too. So I got both.
Oh, you got a good deal, obviously. Good on you.
Yeah, well, I wanted it.
Yeah.
What do you
Good
see
one.
happening next week other than Apple going up on my spending?
Well, look, given that there's this indecision happening at the moment, I think the market's more likely to push higher this week. But look, there's a lot going on in America at the moment, as you were just talking about before we came on the show, which can cause a bit of uncertainty. And you're heading towards an election later this year, isn't it?
Yes, it's going to be an ugly battle, I think. And I don't enjoy watching it. So I'm ready for it to be done. Ready for
Yep.
America to be back to easier days, like 1954.
Okay, there's no going backwards.
All right, Janine, thank you so much for being with us. We will find you at wealthwithin.us. What's your final word tonight?
Just make sure that you've done your homework before you invest in any stocks. It doesn't matter what any commentary is saying about the share. Always look at the chart first. And if you don't know how to look at a chart, then it's time you learnt. Give us a call.
Fantastic. All right, we will be back next week with more from wealthwithin.us. We will have Dale Gillum back, I think. And Janine, we'll talk to you again in a couple of weeks. Take care. Thank you so much.
Take care. Bye for now.
Bye-bye, everyone.
Please remember that this report is an educational tool. While Wealth Within holds an Australian financial services license, the information featured in this program is general in nature and therefore should not be relied upon. Before making any investment decisions, you should consult a licensed professional who can advise whether your investment decisions are appropriate for you. We hope that you enjoy this week's report.
Hi everyone, I had a great chat with Jim today. We were worried about storms, political events, and all sorts of things going on in the US at the moment. I don't know how you guys are actually coping with it all, but I hope that you're all well. Let's get into the market, shall we, so that we can talk about what's happening from the financial side of things. Now, looking at Dow Jones, you can see there that it actually had a reasonable week last week, so it did move up. We saw it push all the way to a high of 26,611 points, but the market managed to close down towards the end of the week, closed back down towards 25,871 points. So you can see that bar there. I've actually set the daily chart, and it's a bit naughty because I should be sticking to the weekly chart and not going to such short-term movements, but this is my last week. Dale's coming back next week, so while the cat's away, the mouse will play. And looking at what's happening on that bar, you can see that the close is low. So it actually opened higher than it closed. And this is what we're seeing across the board here. So markets, typically there was a bit of a sell-off. And what happens is the experienced come in and they decide, well, okay, we're not happy with where the market's going. We think there's a bit more risk to the downside. They've taken the foot off the accelerator. We did see this gap get closed, but I was hoping it would actually push higher and we'd crack through that 27,000 point mark again before it actually came back. Now it failed to do that, so there is a slight chance that we could see the market move up. We may see it move down for a day or so before it does that. I'm hoping that the market just pulls back gently and then up it goes again temporarily. Any strong move back means that the market's going to head back below this point here, which is the low that we saw on the 15th of June. If that happens, then look out, the market's coming back down to 24,200 points roughly, and we could even see it head as low as 23,800 points. So the hope at the moment for the market is, and it's not about hoping and praying, it's about hoping that the market will do well, but having a plan in place to make sure that you're protecting your downside just in case it does go against you. So looking at that short-term action for possibly 1 or 2 days and then a push back up to see the market challenge that 27,000 points. That would be the ideal scenario. But as I said, there is always the risk that the market could take out this low here. Now, it may not do it next week. It might be into the following week, and I'm hoping it's not a fast sell-off, that it's actually quite steady. But but then if the market creates gaps on the way down, then of course there'll be an opportunity for it to rebound and push back up again. So you'll have to wait to hear more about that from Dale next week. Let's just have a look at the S&P 500 just to see how that compares. We saw the S&P 500 close up for the week, so we saw the market head back above that 3,100 point mark, which is good for this the broader market, but see there's still that gap up there towards that all-time high. So that's why I'm expecting that the market could just slowly trundle up and fill that gap to challenge that all-time high in the short term. Now, if it fails to do that, as I was talking before, it's a similar scenario for the broader market. If there's a real risk, if it does take out this low on the 15th of June for the same discussion that I had in the Dow Jones that we could see play out here. But the same story applies. I'm expecting a short-term pullback before we see it move back up. But we could see the market move at least back down to 3,030 or 3,040 points over the next couple of days as it eases off. So that's the S&P 500. Now let's have a look at some stocks. I've got some interesting stocks to chat with you about this week, and at least one of them I referred to in my discussion with Jim Beach this week. So the first stock we have today is actually Spotify Technology, and the code, have a guess, is SPOT. That's probably aptly set for Spotify. Now looking at the chart there on the screen, you can see there's not a lot of data. Now, you'd see more if I actually had the chart set right as well. So I've just clicked on that lock on the right-hand side to unlock it and reveal a few secrets there about Spotify. Now, what we did see when the stock launched on the market, it actually traded up. Its debut was actually quite good, and this is typical of what happens with new stocks when they launch on the market. There'll be that excitement, enthusiasm when the company first comes out, and being a technology type stock, it would have seen a lot of media play, no doubt, and then traded up for a few months only to just be whisked away and sold off. Short sellers took over, people exited the stock to take profits. This is just so typical of what happens on the market. Now, stocks will often be trading lower than their issue price within the first 12 months that they list on the market. So there's at least a 50% chance with companies that list on the market of this happening. So we saw it happen to Spotify. It shows the volatility, but then it started trading sideways. Now, what's really interesting is during COVID, it traded down for a couple of months. And while the drop was significant, it went all the way from about $1.60 down to $1.10, it then reversed strongly. So some good news has come out, but we saw that an announcement, the Kardashians are in the news again with Spotify, and there's been some deals with creating podcasts, which is great. And because of this excitement that's going on with Spotify, we've seen the share price rocket off, but also because there's a lot of speculation going on in the market at the moment and investors are looking for anything that moves, we have seen this stock take off, and brokers are setting huge targets on the share price, $275. So the stock's actually rocketed through that high that it achieved just after it listed in July 2018, and it's traded all the way up to around $240. Now, can this be sustained is the real question. I'd say in the short term, I don't believe so. I think that there's a real probability that the stock will come back and test close around to the $200 mark. We can see that the stock did trade sideways. On the right-hand side of my chart, I've got the daily chart there. You can see that the bar's moving sideways where the stock was showing this indecision. It was trading higher, then trading lower. So people were range trading the share, and eventually it took off with the news. But the sad thing for a lot of investors is that most of the rise was already had there. It was already there in the months in the lead up. And this is typically what happens with smaller companies. They get ramped up. The people in the know are putting their money into the stock, and then what happens is the news comes out, the little people jump in, it goes up for maybe a couple of weeks, and then the fire burns out and it dissipates. So, but we could see it as profit takers take some money, temporarily come back. There is a potential, as I said during Jim's report, for it to trade up to the target that this broker mentioned, given the momentum that's behind the share and the technical information that I can see off the chart. But there isn't a lot of history, so that's what you have to be mindful of when you're looking at these types of shares. Anyway, that's Spotify. The next stock is a big one and very popular. And again, I was chatting with Jim Beach about this one. This is Nike. Very interesting company, Nike, and one of my favourites. And looking at the chart here, I've got up on the screen for you, you can see how beautifully this stock trends over time. Now, COVID actually slowed it down a bit, which is probably a good thing for any share. I'll just show you the entire history of the stock. I'll bring it up so you can see the whole monthly chart there. So you can see there that Nike's had a fantastic run over time. It did come back during the GFC. So this is the GFC, believe it or not. You know, it actually puts it to shame, doesn't it? You know, what was all the fuss about during the GFC? But that actually was a significant pullback for Nike at the time. If you go back and look at the chart back then in terms of the percentage fall it had, was really significant. And since then, the stock's actually recovered really nicely and just continued to move higher. So it's probably about time that it had a reasonable connection, a sell-off, because whether it was COVID or some other issue that caused it, there's always something that causes the momentum to be lost and for a stock to come back and test support. Now, $60 was actually a really important level for Nike in the past. We can see that there's a huge sideways move that occurred here. This was all the way from August 2015. It's just come back to test that again as part of COVID. Now it's been challenging that all-time high. So you can see an incredible high there, well over $100. When a stock trades to $100, it sometimes acts like a really psychological level for companies that occasionally they can't get over. And it may take some weeks or months for the stock to do that. So we could see it come back in the short term, and as I said in my report, I was expecting it to trade lower. And when you look at the monthly chart, it really puts that into perspective. So at this point in time, I wouldn't be putting my money into Nike. I'd just be waiting and being patient, because at some point it will return to being a really good trending stock. So that's Nike. Now let's move on to the next one. This stock I find fascinating. It's IBM, International Business Machines Corp. Now we can see here that IBM has had a really checkered history. It's quite a volatile stock. A different picture, isn't it, to what we just saw on the Nike chart. Much more volatile in the down moves, big swings up and down when it's actually making its move down. So we saw this incredible low here. This was actually not even the GFC low. This was in 2002 when the market had a big pullback. And then again, we saw another further decline in the GFC, which actually wasn't as much as what the stock had moved down from this high in 1999. So a lot of different things happening there at IBM, and not wanting to get into too much detail on that at the moment, but just purely looking at the chart. Now we saw that the stock eventually broke through $200. Remember, those round numbers can sometimes be important. Pulled back, found support at around $100. Now this is a really important level for IBM at the moment. If it can trade up from here strongly over the coming months, then this could provide long-term support for the share price. So that's really what we've got to wait and see at the moment. It's in a bit of state of flux right now, as everything is in the market. But after the last fortnight, it actually hasn't looked as strong. So a bit of indecision there we're seeing. So not as strong as the overall market, that's for sure. I would like to see it actually head back up above about $1.30. Then it could push closer to that prior high you can see there, which is closer to 160. We could see it move back up. And that's really important for the stock. If this stock can break back above at 160, long term it's more likely to be up. You know, this is the real challenge for the share right now. But short-term traders potentially could be making some money out of it as it moves up. Now, on the downside, if it trades below this the week ending 12th of June, then I would be treating this with extreme caution, because that means it's more likely to come back and test itself closer to the $100 mark. So that's IBM, another interesting company there, and one to keep an eye on. Now, I do like the big Dow stocks, you will have noticed, because I talk about those a lot. I'm going to hand it over to Dale. Next week he'll be here to talk about some stocks from other parts of the market. But I thought I'd bring up Walgreens Boots Alliance, because it's been trending down for a long time. So a lot of people had the perception that COVID hit and all of a sudden that's blown up the market. But as you're seeing here, we're witnessing a lot of stocks that were already in decline at that point. So this particular company, it was trading below $40 in COVID. What you'll notice on the left-hand side of the chart is it spent a lot of time trading in a range between $30 and $40. This was back from around 2000 all the way through to around 2013. It was trading within that range. So long-term buy and hold investors were probably getting really sick of the stock, and often what happens is they end up selling it off, and then of course eventually it goes up again. But this is why time in the market is not the big thing. It's timing the market that's important, as you will have seen on these charts, to be in the shares at better times rather than the highest risk times. So Looking at the stock right now, it's still a high risk time because the overall trend is still down to this low, but we're starting to see a little bit of consolidation happening at this bottom. And this is one of the reasons why I picked this share to talk about today, because if the stock gets back above this recent high here, which is of 2 weeks ago, about 47.38, there is a real potential for it to start heading back up through the $50 mark, and it could trade up to around between $50 and $60 over the short to medium term, which would be great to see the company start to recover. But look, it may still trade sideways for some weeks or months before we see that unfold. And of course, risk to the downside being the most important thing to always be thinking about. Or if the stock starts to fall away and it heads back below $40, I would be quite concerned about the share, and there could be further downside ahead. So that's Walgreens. Now, the last one for today, everyone, get ready, have your drum kit out and do the drum roll. American Express Company. Now, this is a popular stock. Everybody has heard about American Express. I don't think there's anyone who hasn't, so I don't need to introduce this one here. Now, look at their chart. You can see the volatility in the share price coming up. Big swings up. And then 2014 through to 2016, we saw the correction. This 2014 period was around the time that the Fed were talking about stopping printing money. And so there were a lot of stocks that actually slowed down and went sideways and pulled back during that time. And it took much longer than I expected to recover. And when it found support on $50, we've seen, okay, it's like an elastic band. All of a sudden it took off, and we saw it trade well beyond the $100 mark and through $130 up here for the all-time high. Since then, it's pulled back quite strongly. We've seen a bit of a sideways move the last 3 weeks, but we've got this gap on the weekly chart down here. So I'm expecting that in the short term, we could see it come back, trade below that $90 mark, and then, we have to wait to see what it does after that. So in the short term, I think there's a potential for downside. If it gets through $110, we could see it zoom up to closer to $130. So this is a stock that would it hasn't moved as strongly as the broader market, but it has the potential to pick up steam if the market does start to keep or continues to move up higher. So that's another interesting one there on AXP, American Express Co. And thank you to those who posted questions, and thanks for watching until the end of this video. Now, if you have any questions that you would like me to answer, remember to type them below and we'll get to them. Dale will be back next week, so come on, get typing. Remember, these reports are done for you every week, so hit the subscribe button now. Click the bell on the right of it, so that way you know when we go live with the latest stock market report. I'm Janine Cox. Goodbye, good luck, and good trading.